Okay, let's unpack this. You are joining us for a deep dive focusing on the Q2 2025 earnings call for Creative Realities, ticker CRI.
And right off the bat, the market reaction really tells the story here, doesn't it? Stock popped over 14%.
Huge jump.
Yeah, an extremely strong signal. It suggests investors aren't really looking backwards. They seem to be buying into management's story, the strong sequential momentum and this confidence in a second half inflection point.
Absolutely. So our mission today is to kind of cut through the usual financial report noise. We'll summarize the main results, definitely dig into those margin dynamics, which were pretty volatile.
Might be volatile.
And then detail the specific big catalysts management is counting on for future growth. We're looking at this like an experienced investor would. Did they execute? And are these future projections actually credible?
All right, starting with the headlines. Q2 revenue, $13.03 million.
Yeah, which nicely beat the $12.27 million estimate. Importantly, that's 34% sequential growth, quarter over quarter. Big jump. Huge jump. Now, revenue was basically flat year over year, and adjusted EBITDA dipped a bit compared to last year. $1.2 million this quarter versus $1.5 million then.
And that's what's fascinating, right? The market just seemed to completely ignore that slight year-over-year softness.
Totally overlooked it.
It's like investors are saying, okay, past is past. This feels like a backlog conversion story, a restructuring play. They've discounted the history and are paying purely for future execution, especially that sequential acceleration.
And management helped shape that narrative, didn't they? They really focused attention away from the GAAP EPS loss, which was negative $0.17. That kind of number often trips up smaller companies.
Right. Instead, they highlighted the adjusted EBITDA, $1.2 million. That's up strongly from, $0.5 million in Q1?
$500,000 in Q1, yeah.
That jump is key. It shows the operational leverage is kicking in, sort of validating the cost changes they've made, makes their claims about the second half seem, more believable.
Okay, now let's tackle the big one this quarter. Margins. Consolidated gross margin compressed sharply, really sharply.
Yeah, down to 38.5%. That's compared to 51.8% last year.
So you got to ask, right, if the business is maturing, why such a big drop in profitability?
Well, management was very specific, and it's crucial people get this nuance. They pinned it on a revenue mix shift, a short-term hit, they said, and intentional.
Intentional. How so?
Because Q2 had a much higher chunk of lower margin hardware revenue, $7.1 million worth, versus only $6.0 million in the higher margin services.
Ah, okay. And why so much hardware all at once?
Tariff uncertainty, that was the reason given. Apparently, a few big customers decided to pull forward their hardware buys, get ahead of potential hikes.
A timing thing, not a fundamental problem with the services margins themselves.
Exactly. Revenue pulled from later quarters, creating this hardware spike now. Management said the core services margins, the underlying health, were stable.
Okay, that makes sense.
And the whole guidance for the back half rests on reversing that mix. They expect margins to climb in Q3, Q4, because now they'll be installing all that hardware.
Right. Booking the higher margin service and installation revenue, shifting the mix back.
Precisely. The key outlook, the number the market's really focused on, is that projection for adjusted EBITDA margin to get back towards roughly 15% by year end.
15%, that's a strong rebound they're aiming for.
It is, but it's also pretty aggressive. It assumes near perfect execution, converting that hardware into services revenue in Q3 and Q4.
What if something slips, like that QSR pilot delay we'll talk about, if installs push into Q1 26?
Then that 15% target gets really tough, potentially leading to disappointment. It's a tight window. We should also remember their exit from the media sales business late last year is still dragging on the year-over-year services comparisons.
Right, but management sees that as necessary pain for the long-run margin health.
Correct. Necessary step for the recovery.
Yeah.
Hashtag tag focus on balance sheet discipline.
Okay, so the operation side is complex. But the stock reaction wasn't just about margins, was it? The balance sheet discipline seemed key.
Absolutely. This heavily influenced the positive reaction. Management paid down about $3.1 million in debt during the quarter.
Using operating cash flow from the period.
Exactly. That shows a real deliberate commitment to deleveraging. That's serious cash generation being put straight to debt.
Okay, that's a solid chunk paid down. But let's put it in context. Gross debt is still around $20.1 million. And the cash balance reported was really low, like $6 million. Is the market maybe being a bit too enthusiastic about that $3.1 million pay down given the remaining debt?
Well, not necessarily. Because of how they manage cash, they explain this treasury sweep instrument they use.
The sweep, right.
Yeah. it automatically applies cash against their revolving debt facility. So it's not just passive pay down, it's active treasury management. It cuts interest expense immediately. That low cash on hand number isn't really a good proxy for their actual working capital capacity.
Okay, got it. That context is important. But what about the leverage ratio? It went up, didn't it, to 4.53 times gross basis?
It did. And 4.53 might sound, a bit high, but management explained that was mostly due to settling a contingent liability back in Q1.
A one-off thing, not operational.
Right. A non-operational expense that kind of artificially bumped the ratio for the Q2 calculation. The main message remains. Converting cash, paying down debt, that's the priority as they work towards a better capital structure. #tag growth catalysts and enterprise credibility.
All right, so debt's being managed. There's a plan for margins. Let's talk growth. What's really driving the confidence here? The big opportunities.
Yeah, the growth narrative. Starting with the basics, ARR, annual recurring revenue, it grew sequentially, $18.1 million now, up from $17.3 million in Q1.
Good, steady growth there. Crucial for stability.
Definitely. But the really big potential everyone's watching is that high visibility QSR pilot.
The upscale chain, over 1,000 locations.
That's the one. Pilot implementation is happening now, Q3, Q4. And the plan is a massive national rollout right after the pilot wraps up successfully.
Okay, but let's ground this a bit. Management did mention a slight delay on the initial installs.
They did. And the reason is almost comical if it weren't impacting timelines. Every single pilot restaurant needed new concrete footers poured for the drive-through hardware.
Pouring concrete. You can't speed that up easily.
Exactly. The physical world bumping up against the digital ambition. But despite that little hiccup, management sounded confident they can accelerate deployment once those initial physical bits are done.
Okay. Beyond QSR, what about the retail media network side? The AdLogic platform.
Good traction there too, it seems. They have 3 major customers in testing and evaluation right now for in-store networks.
And the potential scale.
Management hinted these could be deals in the tens of millions of dollars, but they were careful to position those as likely landing in fiscal 2026.
Right. So not immediate, but significant pipeline.
We also heard the DigiPoint Media Network deployment slipped a bit, didn't it, from Q3 to Q4?
Yeah, about 2,000 sites. That one's expected to bring in over $4 million in initial revenue. Minor slips aren't ideal, obviously, but the size of these potential deals suggests the underlying momentum is real.
And this all circles back to credibility, right? They mentioned achieving SOC 2 Type 2 certification.
Which is a very big deal, not just a checkbox. It's a high barrier to entry. Management sees it as a major competitive advantage over smaller players who just don't have the resources for that level of compliance.
It validates them for large enterprises, handling sensitive data, integrating properly.
Exactly. And speaking of large enterprises, let's not forget the huge 7-Eleven opportunity.
Right, the parent company's expansion plans, adding, 1,100 restaurants and 1,300 new enhanced stores by 2030.
Massive expansion. And CRI management estimates, if they remain the vendor for those enhanced stores, that could mean over 17,000 more displays.
Wow. And the revenue potential? They ballparked it at $30 million in cumulative revenue, plus another $5 million annually in recurring SaaS revenue over 5 years.
That's a staggering number. But how secure is that really? I mean, they're an incumbent vendor, sure, but for a deployment that big, wouldn't 7-Eleven run a competitive bid?
You have to assume so, right? Once deals hit that kind of scale, competition usually heats up fast. Experienced investors need to ask how locked in that pipeline truly is. That's a high-stakes question. #tag, this is not financial advice.
Okay, let's switch gears. Imagine we're pitching this to an investment committee. How do we frame it? The positive stock reaction, even with those lower current margins, it tells you the market's already pricing in that second half inflection we talked about.
Right. So the core thesis really rests on 2 things. First, you're betting on their operational execution, that they can actually deliver on the margin recovery as the services revenue comes through.
And second,
you're buying into the deleveraging story, that the operating cash flow keeps flowing consistently and they keep chipping away at that debt.
Okay, so the outrageous but plausible trade idea.
It's pretty straightforward, really. A highly directional long position on the common stock.
Betting purely on
that big QSR pilot, getting the green light for a full national rollout, and that announcement hitting by, say, Q1 2026. It's a conviction bet. Operations overcoming the capital structure worries.
And how would you maybe structure that to manage risk? juice the return a bit.
Well, again, not financial advice here, but one way to think about it is partially funding that long position by writing some short-term puts.
Selling volatility.
Exactly. Capitalize on the recent volume spike. You're essentially betting that the operating cash flow keeps coming in strong, keeps reducing debt at the pace we saw in Q2. If they pull that off, their cost of capital drops faster than the market expects, which should support that aggressive long view.
Okay, so wrapping this up, what does this all mean for you, the listener? The key takeaway seems to be strong sequential growth is there. There's a clear and frankly credible story for margin recovery in the second half.
Driven by that shift back to services installation.
And there's real tangible proof of financial discipline with that debt paydown.
Yeah. So for the next, say, 6 months, all eyes need to be on execution milestones. Watch that QSR pilot rollout, like a hawk specifically, when or if they confirm the national launch.
And watch the progress on those 3 retail media network tests.
Yeah.
Converting those is key. That execution is what separates a real turnaround story from just, clearing out the backlog quickly.
Absolutely.
And here's a final provocative thought for you to chew on. The market is clearly placing a lot of value on the potential of these huge QSR and retail media deals. But remember that QSR pilot delay, because they had to pour concrete footers at every site.
Yeah, the physical reality.
So think about this. What other unforeseen physical infrastructure hurdles might pop up and potentially delay or even derail those multi-million-dollar in-store retail media network rollouts? Space inside stores is often way more constrained than a drive-through lane.
That journey from a signed contract to actually getting hardware installed and running in the real world, that's always where the hidden risks lie.
Something to keep in mind. Thanks for diving deep with us today.
We'll catch you on the next call.